Hi, this is John Hyre, and for a little while, I am answering questions for free and not behind the paywall that is my inner circle, which has a good deal more than just answering questions. And I say just answering questions because that normally would run you $1,500 an hour one-on-one. But let's get to it. I invested my self-directed IRA in a real estate investment. We get that a lot. Property is being sold and the LLC will be ending. So it sounds like it was one property for the LLC and the LLC is naturally ending. That's important. I underlined it because there's some context that comes out later. The accountant, also a sweat equity member for investment, says that we should do a dissolution of the LLC so that the income being distributed to the people who did not invest money, such as the CPA, via our IRA or earned sweat equity. In other words, people who earn sweat equity, get this underlined. We want the people who earn sweat equity to be able to take the gain part of the distributions as a capital gain instead of ordinary income. So here's the theory the CPA has. I am a sweat equity member. I would normally have to pay ordinary income. But if we do a dissolution of the LLC, I am entitled to capital gains. That is not correct. In fact, what I would ask the person who asked the question is go back to the CPA and ask him the theory. Now, I think they're wrong, and I'm about 97.5% sure on this one. There's always some small chance, maybe I missed something. And that's why I'm asking, because I'm curious. I mean, if there's some technique I don't know about that would be helpful to my people, then I want to know about it. I don't think so here, but I'd love for the ask to occur. It's not really the gist of the question, so I'm going on a tangent, but it's an important tangent. Again, we have an accountant who thinks that their sweat equity is taxable for ordinary purposes as ordinary income, and they want to convert it to capital gain, and they think that a dissolution of the LLC will get them there. And I can tell you that's not how it works. When the asset is sold, the character of the gain or income, whether it's ordinary or capital, is decided at that moment. Now, as we've talked about extensively in the inner circle, you are sometimes able to convert sweat equity into capital gain. It's called a carried interest or a profits interest. And it's when I am, this is a classic Mitt Romney, Bain private equity type of move. I'm the promoter of an investment, and the underlying, this is really important, the underlying investment produces long-term capital gains when it's sold. For example, we invest in land. I'm the guy who put the deal together. We held the land for, let's say, 4 years. And instead of being paid by everybody, a W-2 or a 1099 or cash, I just get a percent of the deal at the end. If you structure the agreement right, the operating agreement right in the beginning, the sweat equity guy will naturally pay capital gains as part of their percentage. Let's say they get 20% of the deal. When the land sells, 20% of the land sale is allocated to them. Land held for 4 years or more is a long-term capital gain piece of property. And so the sweat equity guy would naturally get capital gains treatment. That's only if the underlying asset itself generates capital gains. Let's change the example. A sweat equity guy is involved in an LLC and we compensate him with 20% of the profit, but he flips properties. Well, properties that are flipped don't get capital gains treatment. Those always generate ordinary income, which is usually taxed at higher rates, and it generates self-employment tax. And we might need a different kind of entity to help reduce that. But bottom line is the underlying nature of the asset is such that when I get 20% of the gain on that asset, I don't get capital gains because that's not how flipping real estate works. The way flipping real estate works is that when you do so, you pay ordinary income with self-employment tax. So it depends on the underlying asset. Now here, I'm going to assume that the underlying asset generates capital gains. I could be wrong. We don't have enough facts to know. But if it generates capital gains, subject to some special rules that apply to carried interests, which is TMI, I'm not going to go into that on this particular question, the CPA probably would get capital gains anyway. In other words, I don't think there needs to be a dissolution. I don't think the dissolution magically converts ordinary income into capital gains. Furthermore, what's happening here is a natural dissolution. It sounds like it was a one asset deal. We set up an entity, we had some land or property, we sold it, and now we're taking the entity apart, we're dissolving it because the deal is done. And so there's a natural dissolution. I just don't think it matters. To continue, the accountant says there are 5 formal steps to do this right per the IRS. Okay, maybe he thinks so. I think there are, depends on how you want to describe it, anywhere from 4 to 20 steps. Just depends how much into detail you want to go. But okay, does this sound accurate? No, but it's dissolving an LLC for tax purposes, if you have a competent CPA, is not difficult to do. We'll go into it in the next slide. It's not hard to do. It doesn't have any magical effect on the taxation of the sweat equity partners, but it's just not hard to do. And I don't think it's necessarily 5 steps. Now, the real question for our client, or not client, because client means they would have paid me by the hour, and then I would be compelled to give them legal advice and be liable for it. This is education. It just slips in naturally. So the question my customer asked is, my concern is that if it's not, then the IRS comes after me as an LLC member because someone else can't pay their tax liability that resulted from audit that found this was incorrect handling. That's very rare. Very, very rare that one member of an LLC is responsible for another member's taxes. Now, there are some newer partnership regulations that can make the entity liable, but they can't necessarily make other people contribute to the entity. It's also not normally what happens. If it's for some reason found to be, so let's say the accountant reports his gain as capital and it turns out it's ordinary. Who's on the hook for that? The accountant. The accountant's on the hook for that, especially if the LLC properly reported the gain. If the LLC, let's say the gain was supposed to be ordinary, and the LLC, using Form K1, reported to the accountant and everyone else, you have ordinary income, and the accountant reports it as capital, the accountant's on the hook. What if the entity reported the gains as capital, and they were supposed to be ordinary, but they reported it as capital for everybody? There, the entity can be liable, but what the IRS normally does is it goes after the people who what? Reported it as capital, even though it wasn't. So the entity, the LLC, reported the gains as capital, let's say mistakenly. The members reported as capital. Who do they go after? Each member for what they reported as capital instead of ordinary. Now, for our customer, Carl, we don't care because he has a self-directed IRA. So if there was no debt, and it sounds like there was no debt on this property, then the IRA is not going to have any sort of tax liability. So he's fine. I think it's very unlikely he would be on the hook. So let's go through that again. No liability to you if the income is timely and properly reported to members. Now, some states, California, may require withholding on a property sale, especially for out-of-state people. And I think in California's case, maybe even for in-state people. Assume also no foreigners. When you have foreigners, especially if they're non-resident, so if they're resident aliens, they have a green card or in the US for over 183 days per year, so under tax purposes, they're treated as a resident alien. Usually you're fine. It's when you have a non-resident alien. Maybe you had some friends from overseas investing. Depending on the tax treaty and the forms filed by the partner, they may have to have their income withheld on. And the partnership does become liable for a failure to withhold on foreigners. So you want to watch for local withholding taxes. And if there are foreigners in the group who are not permanent residents, then you really want to take a look and see, is there a withholding obligation? And if so, what is it? Now, dissolution is a standard thing, especially in a case like this, where it looks like the LLC was set up to sell a piece of property. It did so. There's no reason for it to exist any longer. So we're going to go ahead and dissolve it. What does that normally entail? Pay all the debts, distribute assets. Now, pay all the debts. Sometimes I have seen an LLC continue if there's a contingent debt, for example, a possible lawsuit. Sometimes the members will put aside a reserve and continue the thing, or maybe dissolve it and put the reserve in escrow. That's rare and depends a lot on how state law is going to treat that. But usually that's not an issue. Usually when you dissolve an entity, you pay all the debts, you distribute the assets, including the money, you close the bank accounts, you file a piece of paper with the state. You go to the Secretary of State or equivalent website, You look for a piece of paper called Articles of Dissolution. Those are usually very simple and very cheap, typically $50. And you file those and you let the state know, hey, this entity no longer exists. You properly file the final tax returns, making sure all the income is reported to all the appropriate people in the proper fashion, and you mark the tax return as final. And again, just to repeat, I can't think of a fact pattern where a property was sold and resulted in ordinary income, which is, again, more highly taxed usually than capital gains, and then a dissolution somehow converts that ordinary income into capital gains. So, Carl, if you have insight on what's the accountant's thinking, I'd be curious to hear it. I think it's very unlikely I'm going to hear something new, but once in a blue moon, I get pleasantly surprised and discover a tax technique that I didn't know, but someone else did. Don't think that's going to happen here, but you got to ask.